Good afternoon, everyone. In this opportunity, I am going to talk about my academic report titled Accounting, Its Evolution, Main Economic Transactions, the Importance of Accounting in Business, the Accounting Process, Payment Vouchers, Securities, and the Accounting Equation. Equation. Accounting is a fundamental discipline for the management and control for any economic entity, defined as the process of recording, classifying, analyzing, interpreting, and communication financial information. Its essential purpose is to generate financial statements, crucial tools for decision making. This report will explore the historical evolution of accounting, describe its operational process, and highlight its relevance as management information system. This report will cover topics such as the historical evolution of accounting from antiquated to the formalization of double entry bookkeeping by Luca Pacioli, and the relevance of accounting information in modern management. I will also analyze the structure of accounting process from identified transaction and using payment vouchers to applying the fundamental accounting equation. The importance of accounting rests on three essential pillars: providing information to users for decision making, serving as a means for internal control and auditing, and supporting legal and tax compliance. The users of this information are diverse, ranging from internal users, managers, and shareholders to external users, investors, banks, suppliers, and government. Becerra et al. 2021 highlight the importance of this information for small and medium-sized enterprises (MIPYMEs) when facing volatile scenarios. Next, I will proceed with a detailed analysis of these topics. Development. Now I will discuss the historical evolution and dual basis of accounting. Accounting development is inherent to the commercial development of civilization. The earliest records were made in Mesopotamia. Primitive accounting manifests itself in the use of ceramic tables and papyrus for the control of taxes, trade, and debts. In Rome, more formal systems were developed, such as the adversaria, draft expense report, and the codex, formal monthly record, and a legal framework was established with the Law of the 12 Tables to regulate the. During the Renaissance, accounting methods were formalized. The most significant milestone was the consolidation of the double-entry bookkeeping principle. Although the practice dates back to 30 double-entry 30th century Italian trade, its academic formalization is attributed to Friar Luca Pacioli, 24 1494, who systemized the Venetian method in his work Summa de Arithmetica. This principle is the cornerstone of modern accounting, ensuring that every economic transaction involves of a duality, upholding the axiom "there is no debtor without a creditor, nor a creditor without a debtor. Leon Serrano, 2023. Another interesting topic is the accounting process, which is the sequence of activities that transforms economic transactions into financial information. The cycle begins with the identification of transactions, which are classified as routine and non-routine. Supporting documentation consists of payment vouchers, invoices, receipts, and professional fee receipts. In credit transactions, negotiable instruments such as bills of exchange and promissory notes are used, which embody a transferable right. Once the transaction has been identified and documented, it is recorded, applying the fundamental principle of double-entry bookkeeping. The company's financial structure is governed by the fundamental accounting equation: assets equal liabilities more equity. Assets, resources controlled by the entity, goods and rights. Liabilities, current obligation to third parties, debts. Equity, residual interest in assets after deducting all liabilities. Capital plus retained earnings. The fundamental accounting equation must remain balanced after each entry. Double-entried bookkeeping ensures this balance by establishing that for every debit, there must be an equivalent credit. For example, in a purchase of merchandise of credit on credit, the asset account merchandising increases, and simultaneously the liability accounts payable increases, preserving the equality of the equation. Accounting beyond simply being a record-keeping system functions as the primary information system for management. Its final product, the financial statement, provides a diagnosis of the economic, financial, and equity situation. Accounting information allows management to evaluate profitability, liquidity, and solvency in order to set prices, plan events, and adjust market strategies. Parraga et al. 2021, in their review of management indicators, point out that accounting provides the foundational data for this analysis, making it crucial for the success of SMEs or PYMEs. It also facilitates internal and external control, ensuring compliance with current regulations, such as the General Business Accounting Plan in Peru, which reduces legal and tax risks. Furthermore, by presenting transparent and standardized information, it generates trust among external users, investors, banks, facilitating access to financing and strengthening the corporate image. Accounting has come a long way from its early records on tables to its current role as a strategic management discipline. Double-entry bookkeeping remains the conceptual cornerstone, ensuring the integrity of the accounting equation. In the modern economic environment, its function transcends mere recording, serving as a vital tool for informed decision-making, financial control, and business survival, as confirmed by recent academic research on this impact of management and accountability. It's all. Thanks for your watching.